The broadcast is now starting. All attendees are in listen-only mode.
A very warm welcome to everyone on the line for this live session at Asian Investing Summit 2020. It's a real pleasure now to welcome one of my favorite MOI Global instructors, somebody who has shared tremendous wisdom, insights, and ideas with us in the past, Asian equities value investor Sid Choraria. Sid focuses on wonderful businesses at wonderful prices in Asian markets, including India, China, Japan, Australia, and ASEAN. Asian markets are inefficient and less competitive relative to developed markets and provide a rich and growing fertile ground for global value investors. Sid has been fishing in those markets for quite a few years. In fact, in as far back as 2013, he actually gained the attention of Warren Buffett with a letter and investment write-up on a Japanese wide mode company. I can reveal the name, it's no secret. I think it was Kobayashi. And Mr. Buffett told Sid to keep his eyes open for opportunities in Asia. And as I'm sure many of you know, Sid has shared numerous ideas with the MOI Global community in the past. They've done tremendously well. And so I very much look forward to your insights and ideas today, Sid. So without further ado, I'll turn it to Sid for the presentation, and I will be back afterwards for the Q&A session. I do want to encourage everyone on the line to type in your questions into the online interface at any time. And with that, Sid, the floor is yours.
Well, thank you very much, John, for that kind introduction and inviting me back. It's been a pleasure. Time flies when you're having fun. I can't believe the first presentation I made was like now 7 years ago, actually, the Kobayashi case study. So, well, welcome and thank you all for joining. And for the live presentation, welcome. Today, I'd like to present, my process, my background, a little bit about the Kobayashi case study because it influenced me, has influenced me as an investor, and I hope influences some of you. And then I'd like to share several ideas, not just one, because I thought instead of a deep dive on one idea, I would share, given the vast opportunities available currently, a few ideas. So moving on to the next slide. This slide is just an introduction. My process, as John highlighted, really there are a few key points here to mention. The first one is that I'm primarily looking for great businesses. What is a great business? A great business is one that has untapped pricing power. It doesn't have to use it, but it has the ability to raise prices. It has a reinvestment opportunity, a small company that can become a big company, or a big company that can become a much bigger company. A company that's generating cash, it's a cash cow, and is able to deploy that cash into growth opportunities, whether in its core business or niches that it can exploit, and the ability to predict earnings and cash flow with a high degree of certainty. That is what I characterized what is a high quality businesses. Now, some Asian countries offer a richer and fertile hunting ground than others, and I'm happy to take any questions on that. The second step really is incentive alignment. Really here, what I mean is compensation structures of management. Who's on the board? Who's the auditor? What is the relationship? How has management allocated cash flow in terms of share repurchases, or dividends, or reinvestment opportunities? People truly matter. Culture truly matters. So paying attention to incentives is really the secret to unlocking, significant, or at least alpha in the Asian market. So I prefer to seek out outsider type capital allocators. Third, a wonderful price. What do I mean by wonderful price? I have a process around that. I think it's about predictability. It is about probabilities. Really understanding cash flow statements, understanding what worst case outcomes are. I think in terms of opportunity costs here, costs of capital, because they differ across countries. They differ across sectors. And then, frankly, we're all going to make mistakes, so I aim to learn from and minimize errors. And that I characterize that on the wonderful prize. And finally, what I'm looking to do in terms of the process is I invest my personal capital with the goal of owning 8 to 15 great businesses in Asia, or global businesses that are growing in Asia with a significant contribution. I'm thinking really very long term, 3, 5, 10, as long as possible. Now, John mentioned the Kobayashi idea. This was actually first presented on MOI in 2013. Sorry, there's a typo there. It was 2013. And I foolishly penned a letter to Mr. Buffett. And I'd like to share that with you because it's central to part of the process that I look for such ideas with the 3 points that I mentioned. The full MOI interview is available thanks to John on the MOI website. I've recently been invited to speak at leading universities, including Princeton, Harvard, NYU, Columbia, which I'm speaking via Zoom this month, at USC, Wharton and Brown on the Kobayashi case study. My background, John's gone over it, so I won't go over that, but for readers who are unfamiliar with me, you can read my background. Moving on, this slide really is the Asian case study where I identified Kobayashi when it was out there in plain sight, but it was ignored by even domestic analysts back in 2013 and foreign institutional investors. So really the three steps really are, is it a wonderful business? Kobayashi is a wonderful business. 125-year history with 155 brands, leading top market shares in many of the brands, big fish in a small pond, ability to introduce products, high contribution from new niches that it creates, and very high returns on capital relative to its cost of capital. So it's creating excess value creation and able to deploy that cash in growth opportunities. Second, incentive alignment, really divestments of loss-making divisions, a focus on ROI, a focus on structuring compensation such that it is structured to return on investment, a history of dividend increases, a history of profit growth, and a history of making prudent capital allocation decisions, including repurchases during the financial crisis. And finally, at the time, at the time it was trading at my estimates of forward free cash flow of 6 to 7 times free cash flow on a forward basis, which I would characterize a wonderful price given the economics of the business. On the right here, a letter I sent to Mr. Buffett where he replies, it's a good company. We're looking for companies like this that we can buy control of on a friendly basis. Keep your eyes open. Fast forward, several years since the MOI presentation, this is the performance of Kobayashi, relative and absolute performance since August 2013. The other indices here on this graph, the S&P 500, the Dow Jones. I think I included the NASDAQ previously, but it's taken out here. Again, lagging, and the various Asian indexes. Kobayashi's increased nearly 4x since then. And what this taught me really is that, you are able to find alpha opportunities in inefficient markets where, most analysts are not even covering great businesses. And that's really the key takeaway as to why I continue to fish in Asia. So moving on from here, before I get into some ideas, I'd like to say, obviously we live in a very unprecedented times. I've seen a few crises in my career, 2000, 2008, and now 2019, 2020. Even in a crisis, resilient businesses like Kobayashi are up. The previous chart was a long-term performance. This year, it's up plus 13%, versus the index is down minus 17. I'd like to highlight several other resilient businesses that are up. I'm not necessarily presenting these ideas, but I'd like to just highlight that in times of crises, strong business franchises, which are highly likely to be around for another 50 years, 25, 50, 30, 100 years in the case of Nestle and Kobayashi, will still do, well relatively. So NetEase is a company I've presented in the past, up 7% this year. Nestle India, it's up 14%. Some of these names, I highlight them because they are great, resilient businesses. They've stood the test of time, and they serve really essential products to consumers. The point or the purpose of this slide really is just to say that even in a crisis, resilient businesses like Kobayashi can do well if structured correctly in a portfolio. Moving on to some of the ideas that I'd like to pitch today. I have really 6 ideas instead of 1. I thought I'd give you a value deal. My past presentation that typically been a deep dive on 1 idea. I thought, just given the breadth of opportunity currently, I would present several. Given the constraints of time, I just kept it to 6. But hopefully, some of you would have some interest in or would learn from the process. So in times of crisis, or really any time, I look for, having learned from the Kobayashi case study, strong business franchises which are highly likely to be around for another 25, 50 years. And those businesses that have strong brands and balance sheets, stuffed with cash, intellectual property, tangible assets, and if the business is available at a wonderful price, really, that's key. The first company I'd like to talk about is Nintendo. The company has a 130-year history. It has a market cap of approximately $47 billion, enterprise value of $35 billion. It has a niche in the gaming space, as many of you know. The company has huge intellectual property, which is not at all reflected in its business value. The company has huge barriers of entry. You and me cannot get into this particular business even if we had lots of capital, right? The company has huge monetization opportunity for its iconic brand in growth markets. It has historically not been run to its full efficiency, which is part of the reason why the opportunity exists. The company recently has partnership with Tencent in China, and per my estimates, is currently under monetizing in the mobile and cloud segments. It has a very strong balance sheet. 30% of its balance sheet, 30% of its market cap is cash. It is also an indirect beneficiary due to the current crisis which we live in. And given the current crisis, I've also decided to focus on businesses that would have an adequate downside protection, not just in terms of cash or tangible assets or IP or barriers to entry, but that have, that are indirect beneficiaries. And Nintendo certainly is one. In fact, it was so popular that it became part of, what I read is there was recent news that it was also being used in the Hong Kong protest, which, is obviously very surprising. But the company's products have been in great demand and out of supply. Most people have not been able to get their hands on some of the hot products that the company has been coming out with. It trades at a bargain valuation for a franchise company. It's a predictable free cash flow yield. I think my estimate 6 to 8% free cash flow yield, which is very attractive for a company like Nintendo that has stood the test of time, 131 years, but particularly also in the context of cost of capital in Japan. It's close to zero. And so that free cash flow yield is a predictable growing one. And I'm probably being very conservative on that. As I said, the company is not being optimally run in the past. It has historically paid out 80% of its free cash in dividends or repurchases, so that's quite high. Now, what are the risks here? The risks are obviously regulatory, which, in my view, it's part and parcel of the game. However, any pullback is likely a long-term opportunity. For those value investors out there, there's another company called Dina, 2432 is the ticker, which trades at a negative enterprise value given its stake in Nintendo. I'd prefer to own Nintendo outright. So that's the first idea. The second idea I'd like to discuss is Shionogi. The ticker is 4507. Again, it's a Japanese idea, 142-year history, 15.5 billion market cap. Enterprise value, again, as you can see, 30% of its market cap in cash, 10.8 billion. It's in the pharma healthcare space. So this company is a niche leader in the infectious diseases. It has great management in Japan, one of the best in this field, and it has past track records of hit products, including Crestor and anti-HIV, products. It is, again, a beneficiary theme in the current crisis environment. I like it not just for that, but really because it has recently signed a JV with Ping An Alliance in China, and I believe, the company's 5-year plan is to be quite proactive in its growth opportunities, not just in Asia, but outside in the US. The company trades at a wonderful price. It is a 12 to 14% free cash yield. 30% of its market cap is in cash, as I said, cash and long-term investments. In the past, it has paid out 60% of its free cash flow in dividends and repurchases. It did buy stock in the last financial crisis, 2008. I like to look for that type of conviction in management. Even Nintendo had a small amount of stock. And so, it tells me that, if that's how management is acted in past crises, this is likely a defensive stock that will do much better than the index. The risks here are poor pipeline. It is in the healthcare space. However, one has to weigh the pros and cons and then look at the current valuation. And I believe that prices this in. And consistent with my second point that I mentioned on the process, I think it's, the incentive alignment and management is top notch, as good as they come. And so, from my perspective, the valuation of Shionogi is very compelling, and I think it meets the criteria for wonderful business at a wonderful price with the right management. The third idea I'd like to discuss is Otogi. Otogi is a South Korean F&B company. Has been around for over 50 plus years. I would think maybe more, but 50 plus years. Market cap of 1.5 billion, enterprise value of approximately the same. This is a dominant Korean brand in sauces, condiments, instant foods, spices, with a high market share in each of its segments of between 30 to 80%. The company has a 15-year track record of growing revenue, 15-year track record of churning out cash earnings growth. The company, in my mind, is a Munger-type wide mode business with pricing power, ingrained in the Korean way of life. They could easily raise prices if they would like to, but they don't. Which is why margins are probably, quite low, but they could easily be much, much higher. And, I've put a Wall Street Journal interview where Jason Zweig interviewed Charlie Munger, and Charlie Munger talks about how Lilu made 20 times his money investing in Otogi. Not surprisingly, anyways, the stock trades at a 6-year low. It's now at a low teens multiple. It's not a high growth stock. I don't think you're going to make 20 times certainly of your money, but it is a very interesting, I would say mid cap wide mode ideas. So this page really, I just wanted to highlight. I could pitch 3 more, but there were only 3 ideas that fit here. But so the idea of this page was to present companies that I think have strong franchises with good management, incentive alignment with investors, and a track record of growing revenue, cash flow, strong balance sheets, which are likely to also be around for the next 25 to 50 years. I can confidently say for all three companies. And those businesses where they are currently available at wonderful prices, what a wonderful price is one, as I said, think about opportunity costs, what else you see out there in the market, as well as cost of capital. On the next slide, I would like to discuss some smaller cap ideas. So again, I think in times of crisis or really any other time, I'm looking for a strong business franchise operating in a niche. Which are likely to be around for 15, 20, a few decades, if possible, and those that have strong brands and balance sheets, again, at wonderful prices, taking into account the potential illiquidity of some of these small cap stocks. So the first one is Central Depository Services, CDSL, in India. It is a market cap of 300 million, enterprise value of 180 million. So as you can see, lots of cash, 40% cash and balance sheet. The company really is what is the invisible toll road and a play on Indian capital markets due to the niche services or required services that it provides to corporates, capital market intermediaries, insurance companies, exchanges, and investors. It has what I would say a rule of 50 or 60 or 70, whatever you might call it, operating margins which are high, consistently high and predictable, and or the opportunity to grow revenue, deploying that type of profitable structure around it with favorable working capital dynamics. And so this company has consistently been increasing its market share. Now in the demat account space, the market share is about 50%. It is an oligopoly. The company trades at a very predictable, conservatively valued 6 to 7% free cash flow growing yield. It is a diversified revenue stream from various revenue streams like issuer charges, transaction, IPO, corporate action activities, online data, etc. As I said, the balance sheet was 40% cash and long-term investments, which provide a downside protection in the current crisis. So the theme, the overwhelming theme, in my presentation, starting out with Kobayashi, is you want to own a good business with, asset value, intellectual property run by the right people that could give you downside margin of safety in this type of environment, which is unprecedented and challenging. The second idea here is Golden Friends, which is a company, a Taiwanese company, 330 million market cap, 270 million enterprise value. It is a leading Taiwanese company in the elevator, escalator, moving walks, maintenance, and has a recurring, a good portion of its business, which is recurring. Now, its client is one of the top, it is the tallest building in Taiwan. It was the world's tallest building from 2004 to 2010, and they had the world's fastest elevator in this particular building. But either way, this company has approximately 30% market share in Taiwan. It's a very defensive business. As I said, there was a good proportion coming from recurring revenue type business, which is a characteristic that defines many great businesses. It's a defensive small cap in a crisis environment. It has a history of 18 years of positive cash flow and net profit. It trades at a bargain valuation, I would say at a conservatively valued 10 to 12%. If you want to be more optimistic, perhaps 15%, 20% of its market cap is in cash and long-term investments. What is very notable was a significant capital return during the financial crisis of 2008. There was significant repurchase, which really is a very positive sign of the company. And so a niche in a company, a niche in Taiwan, in a business with some barriers to entry, high profitability, trading at a good valuation, and a business that has won, some of the most prestigious clients in the country. And I believe the dividend yield or so is about 6%. So that makes it interesting, 5 to 6%. The third idea is another company like Utbogi, I would say Bingray. For those of you who have been to South Korea, banana milk, believe it or not. Well, before that, it's a 390 million market cap company. Enterprise value is 140 million. The company makes some very popular products in South Korea that is ingrained in the culture of South Korean lives. Like every South Korean knows and has, swears by the banana milk beverage. As silly as that might sound, but the company Bingray has many other popular products that are ingrained in the culture of South Korean lives. And that is likely not going to change for 25, 50 years. This company has a 15-year track record of, single digits revenue growth, positive cash flow. It trades at a bargain valuation of between 20 to 25% free cash flow yield. Almost 2/3 of its market cap is in cash. So as you can surmise, it has a lazy balance sheet, not the best optimally allocated. Nevertheless, it gives me some comfort amongst this crisis. The company over a long period of time has distributed about 40% of its free cash in dividends and repurchases. It did also purchase stock in the financial crisis. As you can see, this is a common theme in many of the companies that I presented today, including Kobayashi. They've all done so in different proportions. I think Golden Friends was the most aggressive, and Shionogi was also quite aggressive. Finally, the last company, again, somewhat microcap, but just to provide some diversity in the various Asian countries, Tien Long, TLG, is a Vietnamese 100 million company with an enterprise value of approximately 78. It is the leading Vietnamese stationery brand with about 60% domestic market share in writing instruments, office supplies, school art supplies, etc. But really, 60% of domestic market share. That's been very stable over a long period of time. It trades at a dirt cheap valuation, partly because of the illiquidity, but really a 7x earnings x cash, perhaps even lower. 20% of its market cap is in cash. While my preference is overwhelmingly to come to small companies that could become much larger companies, I think that there is a small place in the portfolio for companies that are, niches and franchisees, like all four of these are. I can say with a high degree of certainty that all of these four companies will be around in 15 or 20 years, which is hard to say or rare to say in a fast-changing world. So with that, John, I'd like to conclude my presentation. It is somewhat different from past presentations, but I thought I would share the Kobayashi case study, my process, and discuss a number of ideas across different markets to highlight the process. And I'd be happy to take any questions you have.
Wonderful. Well, thank you so much, Sid, for that presentation. Just a reminder to everyone on the line, if you do have a question, feel free to type it into the online interface. Sid, perhaps a couple of general questions. One, could you talk more about your idea generation process? Because you've consistently surfaced these high-quality businesses at very good prices. How do you go about generating ideas?
Firstly, John, I lead a very boring life. I'm practically reading filings every day. That includes a Saturday and Sunday. So I wouldn't suggest that type of lifestyle on anyone else. But frankly, I look, what I am looking for, I think, in you've witnessed part of my evolution. Well, definitely a big part of the evolution, because when I started out many years ago, I was very interested in statistically also cheap companies that were not necessarily going to become larger companies, and perhaps one or two of them at the back, fit that still. But again, the odds are very good. I constantly, the first really most important thing is it a great business? If it's not a great business, I'm simply not interested, because life's just too short. You only have a finite amount of time. And, I've distilled my process in terms of what a great business is down to what I believe is a science. And there's a lot more than the 4 points that I mentioned, but really, I am looking for a high degree of predictability in projecting these earnings. So I maintain a list of companies across different markets, perhaps say 20 or 30 businesses in, say, China or India. Japan is a market I love to fish in because there's lots of great companies, which are followed by not so many great analysts. So I maintain a list in each country of the best businesses. And I typically don't like that list to get very long. It has to have probably, I would say, depending on which country, 20 businesses or so, 20, 30 businesses that have some of those characteristics I mentioned: pricing power. Can they raise prices, right? What if they raise prices? What's going to happen? Reinvestment opportunity. This is very, very important. This is something I garnered obviously from one of the MOI members. Chris Mayer, his book 100 Baggers significantly influenced me, and I think the importance of reinvestment is significantly important, because I want to minimize my investment decisions. If you're going to own 8 to 15 great businesses and you want to own, the big money is really made by owning them over a long period of time. And that's why Manga says, even if you buy a great business at a fair price, you'll do okay, because part of the returns on equity, if you own it long enough, you should do, similar to that. So the reinvestment opportunity becomes critical. So that's something I really pay attention to. So for each business on the watch list, I say, where can this business be 5 years and 10 years from now? And many businesses, frankly, are never going to become big businesses. And so you just drop it off the list. I think that's the trap that many folks get into, including myself in the past, is looking at businesses that frankly can never become big businesses. And then I don't like lots of leverage. I never think it's a formula for success. And so I look for, there's plenty of great companies throwing out lots of cash. The key question is, what do they do with the cash? So I have a very analytical approach at dissecting what they've done for 10, 15, 20, 30 years. It's a very analytical approach, although I've not shown it on the slides. The approach is very analytical. I have a process in which I would look at a company's track record over 20 years very quickly, and I can compare it to a company like Apple or Amazon or a company in Europe. And I am always looking to compare, okay, well, if I presented Kobayashi, how is it allocated its capital relative to, say, Apple? I know that's a very different type of comparison, but I like to kind of say, okay, if this is the best in class, how does it compare to the best in class somewhere else? Because you're really investing is about opportunity cost. Although I'm very focused on Asian markets, I tend to look for the comparisons with best of breed companies, even in the US and Europe, constantly. And so that track record, which is a very analytical approach, which have not gone over during the presentation, is quite important. Which leads me to some of those idea generation. As you saw, one of the elements I kept repeating was, well, they repurchased lots of stock in the last financial crisis. They have this much cash on their balance sheet. Okay, they have a certain amount of ownership by employees, etc. What is that number? Well, it's a magic number. But I'm looking for a certain of those criteria. And finally, I think ultimately a company's objective is to throw out cash. Really, that's really the objective. And so different cash, a dollar of cash with Kobayashi is very different from a dollar of cash in a company that cannot allocate it well. And then you're looking at the probabilities and predictability of that. So I think valuation is taught very incorrectly in most business schools. don't emphasize the concept of predictability and really how one ascertains if that dollar of cash flow or the future, is going to be more predictable. We just learn about how to do discounted cash flow analysis. We think about putting assumptions, but they all have different predictabilities associated with it. And so from a wonderful prize perspective, again, that's a very analytical approach. It might not seem so from the presentation, but very analytical approach as to what is the predictability of this company. And I think you can mathematically define that. I have my own process. It's certainly not perfect, but it is a process. And so those are really the steps. Now, I also, I have a network of friends in different markets, which I talk to, because I'm not an expert on, say, for example, Japan, but, I know enough from reading filings, but I think just maintaining a network, certainly the MOI network, very helpful. I look at other things like corporate actions, spin-offs, etc. So it is a wide degree, but really, John, at the end of the day, I'm really looking for those three things so that I can minimize my investment decisions, which I think is really very important to outperformance in the long run.
Sid, you also mentioned pricing power and that the companies don't necessarily have to use it. But how do you identify companies that have the kind of pricing power that you look for?
Yeah, so Otogi is, I encourage John, I encourage you and all MOI members to read this particular interview that I put on there. It's a very good interview by Jason Zweig interviewing Charlie Munger. And I thought that was very interesting. Otogi has untapped pricing power. It is ingrained in the Korean way of life. If you go to a Korean household, you're gonna see Otogi and you're going to see Bingray. You're just gonna see them, right? And that's not gonna change for 25, 50 years. And then you look at the margins and you're like, well, why are the margins not as high as what I would have thought? That's because, this guy is obsessed with market share. He's got like a 90% market share. And what Charlie Munger mentioned is that, they have a 90% market share. He wanted to dominate it, and, he clearly has. And so, look, he now is in the lives of every Korean, and I think it is a small spend. And so there is going to be, again, it's a qualitative assessment, but almost no impact if Otogi or Bingray raises prices a little bit every year. It's just much like a Coke, or it's much like a Marico, which is an Indian company, a parachute oil. They're synonymous with the potential culture. So I do look at the P&L, and I try to make an assessment as a business owner as to, does this reflect do the returns on equity reflect the high market share, the cash generation? And I think that's partly common sense. And with Otogi, it's clearly under earning, as also outlined by Mr. Mungo on the interview. And so, looking at trailing multiples, etc., is sort of misleading. But I also have a quantitative way to think about it, John. I think I do look at gross margins adjusted for certain items, sort of borrowed from the Richard Lawrence approach. Richard Lawrence is very, I would characterize as the Asian Warren Buffett, focuses on a pricing power a lot. And I think that ultimately you're looking for a long track record of being able to grow revenue without necessarily seeing declines in gross margin, and obviously relative to other companies. So Maltai's, was an idea that we discussed many, now seems like a lifetime ago. That company has 90% gross margins. If you look at the other Baiju companies, the gross margins are 60, 70. Well, Maltai is still growing its revenue even when the Baiju market was down. So that's pricing power. That's an example of a company that obviously uses its prices to its max, and I'm not sure how much more they can raise it, but I suppose. But Otogi and Bingray and Marico in India are examples of companies that are not pricing their products to the optimum. And so there's definitely that needs to be factored in.
Well, thank you. That's very helpful, Sid. A more specific question on these ideas you've talked about. Would you hedge any of these currencies like the INR or VND?
Well, I think that typically, look, if you find a cheap hedge, you should always hedge, right? If you find them. But with certain currencies like the Japanese yen, it's easier to hedge. With the Indian rupee and the Vietnam, it may be less. But really, what you're looking for, therefore, you're looking for a no-brainer price. And so your IRR estimates need to factor in a potential decline in the currency. So if you make an assumption that the Indian rupee is going to decline 3% every year, let's just make up a number, well, then just make sure that your IRR expectation is bakes into that type of thing. So if, my goal is to compound annually at high teens, 15 to 20% in dollar terms, and then so I would just need make sure that a company like CDSL or Nesco, which are presented, which are both on an IRR perspective done very well. I think the Indian market on an IRR perspective, even the index has beat over a 20-year period, has beat the US indexes. So I think you just look at it from what is your IRR objective and make an assumption as to kind of the currency decline historically. But no, I think if you have a well-diversified and I mean a focused portfolio of great businesses at the wonderful prices, I think it takes care of itself.
And Sid, just to let everyone also know, you participated recently in the Intelligent Investing in Crisis Mode event, and I would encourage everyone to listen to that presentation as well. Could you talk just a little bit more about countries in Asia and how you see their relative attractiveness? Now, that's going a little bit more out to the macro scale, but where do you tend to find the kinds of businesses you look for?
No, actually, I think, John, it's not at all a macro question. I think it's got almost nothing to do, like in my view. I would have thought that like many years ago, but frankly, as I said, I'm spending every day reading a filing. That's my goal. I read a filing every day and I take notes, of a great business. And if it's not great, I'm not reading it again. There are just far greater great businesses in India and China in particular, I would say. And what is a great business? I mean, without giving away too much, I would say that, I mentioned this rule of 60 or rule of 50. What I'm really looking for is a company that, and without giving away too much, when you do the math on all the companies listed out there in every country, statistically, the data doesn't lie. And the data suggests to me that China has the most number of opportunities. Now, mind you, Chinese companies also fudge the most in Asia. You had the incident of recently Luckin Coffee. I'm not making specific comments on the company in itself, but the stock was down 80%, et cetera, and had some marquee investors invested. So investing in China is not necessarily without risk, but that is a market that is a fertile hunting ground. You'll find far more companies growing very fast, which is a key ingredient to having a long-term, outperformance. You want fast-growing companies that have reinvestment opportunities. China is a 13 trillion economy. You don't have you can find lots of successful investments there. India, it's a very interesting country. Now, India is being left behind, by China. They started off on a similar path many years ago, well, 2 decades ago. And the GDP per capita of India is shockingly low. It's much lower than even Philippines or Vietnam, I think. certainly I think Mexico. And so that is a good thing, because from an investment perspective, many of the PE multiples for these Indian stocks are not reflective of what the true earnings power could be if the company was just a lot wealthier, which it has to be, because GDP per capita cannot be so low over a very sustained period. And so it's like shockingly like 2,500 or something like that. So if you take a view that India's GDP per capita has to rise over time, over a 10, 20 year, you're going to get massive opportunities in the stock market there, even if optically some of the companies look expensive, right? Now, outside of India and China, I love Japan. I think Japan connotes this image of these well-dressed Japanese corporate, where decisions are taken slowly. There's lots of bureaucracy, and there's certainly a lot of truth to that, not just in Japan, but really anywhere. Now, this is changing. As you know, the activists are, very interested in Japan. All the private equity guys are there. The activists are there. Dan Loeb is there. There's a lot of attention on that because there's lots of cash there, lots of cash on the balance sheet, which is part of the reason I presented two Japanese companies, Shionogi and Nintendo, both have 30% cash on balance sheet. And that is not necessarily rare. Actually, many companies have a lot of cash on its balance sheet. The question is, what do they do with it? So I look for. So I think Japan is changing, and both the companies that I presented, and including Kobayashi, I look for Japanese companies that really can succeed outside of Japan. I'm frankly not interested in any Japanese company that can only succeed in Japan. That is a very quick skip. So there are only a handful of companies, I would say 20 or 30, or perhaps maybe bigger than that. But as I said, 20 in India, 20 in China, 20 in Japan. And then you go across South Asia. Frankly, South Asia is a bit underwhelming for me. Every time I look at companies in South Asia, I'm always very disappointed. Perhaps it's a reflection of me, but it's not very easy to find great businesses in some of these economies. Perhaps they're too small, perhaps, but there are, 2 or 3 good businesses in each of these economies. I would say, Thailand has maybe 2 or 3 of them. Malaysia, Malaysia, looking at this slide, Hartaliga is one of the stocks that is up 33% this year, and some of the best performing stocks this year are Hartaliga, Top Glove. They're Malaysian glove companies, and so they are what I would say a look at companies in these Asian countries that have niches for what the country is known for. So, for example, Thailand's very well known for tourism. Well, then you try to buy the best tourism place. The airports of Thailand is a world-class airport. It's down 30% this year. Still expensive, but certainly would be on my shopping list. In Malaysia, you look at, these glove companies because they're niches. They dominate the global. In Indonesia, you look for, there's great. So Indonesia has 250 million people, and so there are a handful of businesses there. So I would say South Asia collectively, there would be maybe 15 on my list. It's not a large number really out of 5,000-6,000, but those are the 15 or 16 that I would think that could stand the test of time, which is really very important because, as I said, I want to minimize the decisions. But Vietnam is very interesting from a very long-term perspective, although the company is clearly going to go through booms and busts. But in the long run, 20 years, I would say Vietnam is very interesting, although stocks are very liquid there. Tien Long, it's a company, a long track record. It has a U.S. partnership, so I picked it. Other than that, I don't focus on frontier markets like Bangladesh and Pakistan. I mean, there's just so much opportunity in China and India. Why would you waste your time? So I sort of focus on, I focus across Asia primarily to understand opportunity costs across each country, John, but I also think that, a particular market, say China, can be very expensive sometimes, but it can be very cheap sometimes. So as a China-only investor, or an India-only investor, or a ASEAN-only investor, or a Thai-only investor, sometimes there just aren't that many great businesses at great prices. But by looking across Asia and having a process and experience in the market, in the region, you over time develop a process that hopefully allows you to pick and choose when Mr. Market in a particular market provides opportunity, if that makes sense. So, over a long period, many people have said to me, why don't you just do India only? I would be depressed doing India only because India for a long period is being very expensive, right? You have these great businesses trading at 60 times earnings. But now they're trading at 30 times earnings, still very expensive. But at some point, they'll trade at 15 times earnings when it makes a lot of sense to go very long India and take off, money off the table in China. So I think it's I maintain a watch list of businesses, John, across the markets, constantly reading filings and taking out the good ones and putting back in, and that process is a continuous one. It's an evolution, and part of the reason I shared the Kobayashi case study is just because it's a reminder to myself as well as other folks that you can beat the market by looking in an inefficient market, and you don't have to buy HDFC Bank or Apple or Amazon. There are great businesses in these Asian markets that are going to be sold off significantly because you're competing in inefficient markets. Sorry for the long-winded answer, John, but hopefully it was helpful.
Absolutely. Thank you very much. And Sid, you've talked about the quality of businesses. How do you look at the quality of management teams, and do you have criteria around the insider ownership of the companies you invest in?
Yeah, absolutely, John. First and foremost, I must say that while it doesn't come across in this presentation, I am a highly data-oriented guy. For me, the data, I have this philosophy in life, perhaps just because I've gone through a few personal crises of my own. Really show me, don't tell me, right? Show me what you mean by action. Don't just say, oh, well, this is, show me your portfolio. Right? And so I think we had this discussion in one of the last meetings where I said, it's great. I read these great strategists, but I don't know how they invest the portfolio. So show me is what I look at management. I say I just look at the data. There's absolutely no bias going into a company. Shinogi was just looking at the data. When you look at the data over a long period of time, you're not looking for 3-5 years. You're looking for 20 years, if you can. Li Lu and Richard Lawrence, the two Asian-focused investors that I admire the most, they look for companies with a long entrenched history. Now, that doesn't sound like rocket science, but frankly, I think that's what I look at is a long history of how has the management allocated $1 of cash. And it is distilled to a quantitative approach. It's saying, okay, Kobayashi has allocated $1 of cash in X of growth opportunities, X in CapEx, X in acquisitions, bought at X price. They bought back this much stock at these prices, this X percent, which was overvalued, Y% which was undervalued, and then you look at the dividends that they paid. Did they pay it as a consistently, what sort of payout versus peers, and could they have better uses of dividends depending on which country you're in? Certainly, I don't want Alibaba making dividend purchases, and so there is a quantitative approach about all these metrics, and that's the first step. Really, is looking at the data. It takes a lot of time. You need to constantly look at the data, clean the data, and it's hard work, right? So it's not supposed to be easy, and it's not supposed to just be like you read a filing and you'll get a sense. Well, you have to look at a very long-term track record, and I think that is what I start with for looking at management. So don't tell me, show me what you've done. in those buckets. So that's the first step. In terms of ownership, John, it depends. I think there's no more magic formula, but I've typically found that a company's founder that owns, about 20, 25, 30% is probably the right number. It depends on the size of the company. Of course, if you're Alibaba, that's obviously too much. You don't want that, but typically about 20, 25, 30%. I typically don't like companies that own 60, 70, 50, over 50%, because frankly, I'm a public markets investor. I'm not looking to, I want the company to have shown a record of having outside investors and increasing the float and whatnot. So I typically tend to look at companies with about 20. Kobayashi, by the way, and where do I get that number from? Kobayashi has about, I think, 15% or so ownership. I think NetEase has about 30% or so. Some of the other companies, the small cap ones, tend to have a higher percentage. So Nesco, which I presented back in 2013, has about 60, 70%, but they're really conservative, but the value is just such a no-brainer that it made sense. The typical number is about 20, 30. And finally, John, I look at compensation structures and mid-management empowerment. So really talking to or understanding how mid-management is incentivized. So really asking them like how that bonus is structured at the end of the year. And if it's discretionary and if it's not, it's just not interesting to me. It tells you a lot about the culture. Then I sort of push them as to why they've structured it that way. Why don't they leave? Why don't they, I try to understand that, because really, frankly, I'd be terribly bored if my incentive structures were aligned the wrong way. And I think incentives, Charlie Munger, pay attention to incentives is something I'm always amazed by. I always am amazed by how people act in life, in investing companies, but really it's probably should be the eighth wonder of the world, pay attention to incentives. So I start with the data without having a bias with the company. Show me the data, don't tell me, and then you take a look at the data, and then you compare it to the best of breed elsewhere. So I like to say, okay, this company in India, Marico, how does it compare to Apple or Amazon or Facebook? So I like to constantly look at businesses and benchmark them to other best of breed, if you would call it. And that helps me keep a multi-market approach versus just a China-only approach. For example, in China, you might say 51 Jobs is a great capital allocator, right? They've done a good job, but frankly, it's quite underwhelming when you compare it to companies in another market or management actions in another market. So by looking at other markets, you get a perspective on the benchmark, if you would call it, right? So that's it's really like going to the best schools. John, you went to Yale. Really, you have a benchmark, and then you sort of say, okay, now who do I compare? If this is what I'm aiming to, how do I stack this guy versus this guy? But it's always the data. The data is the most important thing.
That makes a ton of sense. And Sid, I've noticed that over time, it seems like you've migrated a bit toward larger cap companies. Is that true? And if so, tell us how your process has evolved in that regard in terms of the market caps you've been looking at.
Yeah, well, I want to make lots of money, and so frankly, not for the process of making money, but for the process of watching it grow, and I think that's fun. So I think that if you're going to invest in a small cap and it remains small, then you aren't making that much money, right? So I think that was just I sort of understood that it's not interesting if a small company stays small. It's interesting if it's like trades at 1x free cash flow, and I pitched one at Manual of Ideas called Tata Sponge, but it was literally trading at 1 times free cash flow. It was a puff. It increased 3, 4, 5x, which was actually quite remarkable and stunning at the time because Prime Minister Modi came on. But really, frankly, it's back down there's been some corporate actions, etc. So then you're relying on your ability to buy low, sell high, buy low, sell high, buy low, sell at intrinsic value. And then you really better really know the intrinsic value really, really well. And so my thinking there was, John, I'm first of all looking for just great businesses. If it happens to be a small business, that's great. That's not an issue, right? I think it works perfectly well in a personal portfolio, right? If you're managing $1 billion, if you're managing the type of money that Lee Lu or Richard Lawrence, you're not going to be able to invest in CDSL or Nesco, right? And frankly, it would not make a difference to their returns. And so it was also I think that's how most investors start. Mr. Buffett was managing a partnership, is investing in these small mid caps, and then met Munger and kind of drilled the common sense to him. And I think that's a natural evolution. The perspective is really, John, just wanting small businesses that can become big businesses. Small businesses that remain, get somewhat bigger, but are available at 1x cash flow. Sure, I'll look at that. No worries. But it won't be a meaningful part of the portfolio. It might be in the sub 10%, below, like the 90-80% would be larger businesses that can become much larger. And by larger, I don't mean 50 billion like Alibaba. I could have pitched Alibaba, Tencent, or Maltai again, but they're great businesses at fairly good prices. But I'm not pitching them because, frankly, everyone knows about them. But they still have great opportunities ahead. But like Kobayashi, I think, which is it was about a 2.5-3 billion, but it can become a 10 billion company. It's going to be a $20 billion company, and it'll be a $30-40 billion company, in 2 decades, depending on what sort of IRR you expect. But really, that is the idea, John. I think I would admit that there are some ideas at the back of the thing, like maybe Golden Friends, that might not become a substantially bigger company, but there's always trade-offs there. And so the reason I have that on there is because the significant repurchase, I think they purchased almost 30-40% of their market cap during the financial crisis. If I'm not wrong, there was some sort of capital return, which was significant, and it just jumped out at me. I was like, wow, that one's very safe in this crisis. I probably wouldn't have it if we weren't in this crisis period. And the same for some of the other companies. So you're right there, John, in the assessment that my preference is towards mid or larger cap. I would say in Asia, anything over 2.5-3 billion, which is small cap in other markets, but reasonably sized here is important. And then if it's a small cap, I really, really, really want to be paid for the illiquidity, because otherwise you're venturing into the zone of being a private equity investor, which my brother is and I'm not. And I think private equity is a very different skill set. I like to, if I'm investing in a small cap, I like to do behind the scenes soft activism writing. So if I ever invested, out of disclosure, I'm not invested in Bing Ray, for example. But if I was invested in Bing Ray, I would be calling the CEO and saying, what the hell are you doing with 2/3 of your market cap in cash? Mr. Bing Ray, please do this, please do that. And I would be engaged in that sort of soft activism, because really I think there's opportunity for change, and that can certainly materialize. So I'm flexible, but all the ideas that I had mentioned here are good businesses. Some have longer runways for growth, and some don't. But typically, I'm looking for those 3 things that I mentioned. That runway of growth is very, very important. And John, I must thank you. It's because of you, because I met Chris Mayer. And Chris, really the one, I asked him, please tell me one word. And he said reinvestment. And I think the reinvestment thing is just so critical. And so if it doesn't have reinvestment, if it's small cap, it better be a super crazy multi-price or super predictable, or I'm able to influence the outcome by engaging in soft activism.
Well, Sid, this has been truly terrific. Thank you so much for being here and sharing your wisdom, as well as the specific ideas that all of us can look at in Asia and add to our watch lists and do more work on. It's always a pleasure to learn from you, and we truly appreciate you sharing your insights with MOI Global members.
Well, thank you very much, John, for having me. I've certainly become smarter, wiser, and wealthier because of MOI, and so thanks to you. Have a good night.
Thank you so much, and thanks to everyone on the line. We look forward to having you check out this and other sessions on our website. Goodbye for now.